With all, I think, forced mergers, or you have an acquisition of not equal parties, you can always have this friction, and I think that is what you see at play here. It was very clear that the former CEO, now former CEO of UBS, was not really happy about this, what we call a shotgun wedding, and I think that's the fallout we see now. And because you have this very big implicit guarantees from the Swiss government and the government being behind the lines of this merger, of course, it's very important I think for the Swiss government, who is in charge of this process that will continue after the merger is completed. So I think it very much smells of friction, and personal relationships matters more in this case. But I think it's quite interesting with the comment about that Switzerland needs one bank. Everything we have seen, I think, since the great financial crisis with regulation is leading us down one path of bigger and bigger banks, more and more concentration, which leads to fragility, but also less competition. And I'm not sure it's long term going to be good for the overall financial system. And it also increases the conversation, or it puts the conversation out there whether are we moving towards more public interference with money itself. Also the discussions in the US after SVB, to what degree should there be guarantees on deposits above the FDIC deposit guarantee limit? If you do that, what's the whole purpose of having banks, private money, etc.? I think there are very big questions here about this and where we're headed in the banking system.
The issues seem to be for Hamas now for Amotti about retention, whether some of the clients, whether deposits, whether money would stay with the joint entity, whether small and medium-sized banks across Switzerland, whether other major lenders would try and pick away at business from the joint entity that is in this integration process. What do you make of the ability for Amotti to hold on to some of that business at this point, but also go back over history and recreate what he did at UBS now for the overall entity?
It's a very good question. I mean, we have a lot of data on mergers and acquisitions, and typically you never get the synergies that you expect, and that is also the case in the banking industry. If you look at UBS and you look at Credit Suisse, the UBS has been a very well-run bank, as you also mentioned in your introduction, the capital light model, etc. If you look at over the past 5-7 years, you have had a return on equity that has been on the good side of 10% for UBS, give or take, depending on what you subtract, etc. And then if you look at the Credit Suisse with closer to 2 or 3%, it's been a catastrophe. So you have a very well-run bank that is now absorbing a very bad-run bank. And the question is, what can you eliminate all the fat and all the bad processes that are clearly in Credit Suisse and get the entire entity back to around that 10%? Because that is the magical number. It's the issue we have on our hands in Europe is that the equity story in the European banking system has been terrible since 2010. Just in the past 5 years, the total return on the banking index has been around 2%, compared to the overall market being up. So there is a very bad equity story here, and that's also the wider problem we have with the AT1 market, which is now displaying yields that are significantly above the return on equity, and that it means that there is a very critical funding source that is now not available to the same degree as in the past. We know the ECB already last year talked about they want common equity to play a larger role in the Tier 1 capital structure than the AT1 bonds. If that's the case, I think that's also what the market is pricing in now, that we are moving towards more common equity, but the equity story is just really bad. And how big is the dilution going to be if we're going to substitute a lot of the AT1 capital with common equity?